an ETF trading system for emerging markets. I am a market analyst and a trader. Over the years, I have explored and developed many computer-based trading and money management systems. Trading emerging markets is a challenge. Every trading analysis method I had tested was a terrible failure. I could not eke out any gains without experiencing unbearable drawdowns. Because of the volatility of the emerging markets, represented by the ETF named EEM, the drawdowns were much too large for any sane human to trade. In my opinion, drawdown is one of the most important factors to consider. I have seen many people who have come up with amazing trading systems that make a great deal of money, but only a computer could ever trade them. A human with his emotions would never be able to take the next trade after experiencing a huge loss or a series of large losses. Many mutual funds use the S&P 500 as their benchmark, yet few of these funds have a historic performance record superior to the S&P 500. This is just one indication that the S&P 500 is not easy to trade. Given these facts, successfully trading EEM seems to be an insurmountable challenge. However, this video presents a proxy strategy for trading EEM using an already successful strategy I've used to trade the S&P 500. The S&P 500 strategy, trading the ETF SPX, employs money management and market timing to capture excellent returns. An adaptation of this strategy is employed for trading emerging markets to achieve outstanding returns without suffering serious drawdowns. This chart is a 5-year daily percent gain of the SPX versus EEM. SPX is shown in black and EEM is shown in green. If you study the relative movement of these two items in this chart, you will see that EEM moves in the same direction as the SPX, but the movement is exaggerated. However, their peaks and valleys line up relatively well. It is difficult to predict the extent or amplitude of their relative movement, but the prediction of the direction is solid. In summary, we can say EEM is much more volatile than SPX. EEM tends to move in the same direction as SPX. The relative price change of EEM is uncorrelated relative to the corresponding change in SPX. I use a proprietary market timer based on several factors related to the S&P 500. Other market timers may also work. The key to trading the S&P 500 is the following money management strategy. Stop losses are not employed. The market timing strategy is straightforward. When the timer is bullish, buy EEM when it starts moving up. When the timer is bearish, short EEM when it starts moving down. When the timer is neutral, stay on the sidelines in cash. In bear markets, EEM is shorted. This is not permitted in IRAs. However, EEM has an inverse ETF called EUM. Rather than short EEM, buy EUM. This eliminates the IRA restriction. Here is a brief description of the adapted money management strategy. When the SPX has gained 5% from its start at the market timer signal, sell 25% of your EEM shares. For each subsequent gain of 5% of the SPX, sell half the remaining EEM shares. Note, this is the identical money management strategy used to trade leveraged ETFs for the S&P 500, except in this case, we are substituting EEM for the trades of those ETFs. This strategy was backtested from November 2006 through November 2010. $100,000 grew to over $350,000. The average annual rate of return was close to 65%, while the maximum drawdown was equal to 7.15%. The percent of winning trades was almost 85%. If you were among those whose equities suffered in the 2008 market collapse, this strategy should be considered. If you would like a more consistent, less exciting, easier to trade strategy, you should probably look at trading SPX using a timer with the proper money management. In summary, we tame the violent moves of EEM using SPX as a trading proxy. Using the same market timing and successful money management strategy that we use to trade SPX, we can trade EEM. Please visit my website, spxtimer.com. Thank you for watching my video.